Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, �モ𝙁. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
COMEX and LBMA gold and silver derivatives. I mean, look at the treasury. Look at the treasury market. When I, in the world that I grew up in and cut my teeth on Wall Street in, treasuries were the rate of interest on treasuries were supposed to lead the inflation rate by about 300 basis points, 3%. So, but I mean, if you look at the 10-year at 287, or even the 30-year at 3.13%, you're still negative in terms of the real rates when you measure it against the inflation rate. So, the Fed has just so inextricably intervened in all the markets that there's just no price discovery. And, again, I guess getting back to what's going to trigger, markets collapsing and gold and silver going parabolic. Who knows what the trigger event is going to be? It could be anything, but when it happens, it's going to happen quickly. And you really do not want to be in paper financial assets when it happens. And you want to already be positioned in physical gold and silver when it happens. So if anything, the artificially low price in gold and silver as engineered in the derivatives market, that's a gift, especially if you haven't really started buying physical gold and silver now. Because I can guarantee you 12 to 24 months from now, there's going to be a lot of people who look back and say, God, I wish I started buying back then. I look back to 2001, and I've got silver eagles that were $4 in my stack. And I've got Austrian gold philharmonics that I paid $300 for. And you know what? I wish I had just unloaded my entire IRA into physical gold and silver back then. But, and you know what? I'm still buying physical gold and silver.
Well, hey, Dave, since you got those at such great prices, would you sell them to me? Because I see you have this like ton, Chinese coin behind it. You don't need those eagles anymore, do you?
No.
Will you give me a discount?
The 1-ton panda.
I think, Chris, you were going to say something.
Yeah, well, in terms of that comment, when he said they were at neutral, I'm looking at the Fed minutes that were released, and they say the rate was around neutral, that is neither supportive nor restrictive. So maybe they're saying they feel under normal circumstances without inflation, that would be neutral. But there is the inflation. And I was surprised because the comment did seem so out of line with everything else that Powell said. In fact, he was talking, as they kept saying, the reporters kept asking, are we in a recession? What happens if you keep raising rates and we run into trouble? And he was actually mentioning that, we need to fight inflation. And even if that means affecting the unemployment rate or the economy, those are pains that we'll have to take, which I was a little surprised to hear that, because that seemed a bit different than anything I remember in my time following Fed commentary. So, like Dave mentioned, you wonder if he didn't get those words out as clearly as he might have wanted to. It was in response to a question. It wasn't part of his prepared remarks, but certainly everything after he said after making that comment suggested that they were going to continue hiking rates and that there was no immediate pivot coming anytime soon. And certainly that's the comments.
If you read the policy statement, and I don't do it. I haven't done it, my entire career, but this is an interesting period, a transitional period in terms of Fed policy. So for the last year, I read the policy statement word for word as soon as it comes out. I don't bother listening to the presser because that's just propaganda and BS. But first of all, the Fed's mandate, you can laugh at this, but they're still referencing it as their benchmarks, is price stability and full employment, right? So I don't see how the Fed can like all of a sudden pivot next month or even in November when you've got an unemployment rate, even though we know it's phony, but they've boxed themselves into that corner, and they know it's a phony unemployment rate also, but that's what they reference when they say the labor market's still overheating, it's still too strong. And as long as that unemployment rate stays, really below, I think full employment when things were a lot more normal back in the Volcker era and the early Greenspan era, I think full employment was considered, under 5%. So, as long as the government rigs the unemployment numbers and it stays below 4%, I don't see how the Fed can use that as one of their benchmarks and pivot, because if they do, that's one of the things that could trigger a collapse in the markets after an initial shoot up and a big rush into gold and silver. So, but the other thing that struck me about the Fed policy statement, the way it was written, and it did mention, it said, and this is a paraphrase, it said, we think it's appropriate to continue hiking the Fed funds rate for several more meetings. Of course, it will be data dependent. Again, they reference that concept, but every single FOMC board member voted in favor of that policy statement as it was written. And you don't see that very often, especially in recent years, because you've had the good cops and the bad cops. You've had the monetary doves, like Lael Brainerd and Neil Cashincarry, and then you've had the policy hawks. So, I mean, even Lael Brainerd and that nut job who's the president of the San Francisco Fed, even they are like firm about, we got to keep hiking rates because the rate of inflation is still too high. And so that's why I think we're going to see it for a while. And that's not bad for gold and silver. It is as the paper market interprets it, but there's plenty of studies out there, the most notable being Adam Hamilton's, where the best periodic rates of return for the price of gold occur when the Fed is starts hiking the Fed funds rate, and they're in a rate hike cycle. Yeah. So, and that goes back to the early 70s, his data.
In 2003 to 2008, they hiked every quarter for 17 quarters in a row.
There you go. Point in case.
Went from 300 to 800, something like that. So
that's right. And the idea is because, if the Fed keeps hiking rates, people are going to know that they're way behind trying to get inflation down. And I think the Fed knows that. If anything, I bet you behind the scenes in these meetings, they're probably, feeling a sense of unease with what they've done in terms of their monetary policy and price inflation, because they also damn well know that the real rate of inflation is more akin to what Shadowstat's alternative CPI measurement is. They know they're freaking morons if they really believe that the rate of inflation right now is what the government is calculating it as.
I want to throw something up to talk about inflation, because I think inflations are very big with respect to this argument. And if we look back the last time we had really big inflationary event, it went forever. And if we look at where we are today, we're just in the beginning. So I wanted to remind people, when inflation kicks up and stays up and it requires a Fed policy response, it's not month to month. We're talking year to year, and it can take several years. This is months to date from the time at which inflation started last time, and in which we had the peak in March of 1980. And you can see there how many months have passed. Is that 155? Am I reading that correctly? So it's not like the Fed can do anything about inflation over the short term until they decide to aggressively hike. And the question for me really is, does this CPI right here continue to march up and force the Fed's hand? Does it moderate? Is what we're seeing now an analog to that previous occurrence? Is it worse? Any short-term talk about inflation to me seems to be premature and maybe a little bit Pollyanna. I think we got to let it play out, and we got to see. We've created more money this time. We have more debt this time. It could be even worse, and it could manifest differently. It could go more aggressive very quickly. So I do think that any assumptions made by the Fed or the rest of the world's central banks about controlling inflation, you really have to look at history, but then you also have to look at how this time is different. And I think now we're in a much worse position. So I don't even know if the chart I just threw up there is even adequate for the current situation we're in.
We're definitely in a worse position now because, first of all, you referenced the debt, but back then you didn't have the money printing. They started printing money as soon as they removed the dollar from the gold standard, but not at the rate that has been printed since 2008. I mean, so, you know, and it's not back then. Maybe it was just a function of hiking, you know, shocking the system by jacking the Fed funds rate up to 18 or 19%, wherever it peaked. And because the Fed there wasn't a lot of money that it needed to remove from the financial system. But now it's, you know, you're not gonna bring down price inflation just by causing a demand shock. They got to remove liquidity from the banking system. And we already know there's at least 2 trillion of excess liquidity in there because that's what's being held captive in the reverse repo facility. If the Fed was serious about attacking inflation, they would convert that overnight reverse repo mechanism into a permanent open market operation and completely remove that 2 trillion from the banking system. I don't think
I got a question for you on that. Sorry to interrupt, but it's a really important question. Yes, they're parking money in reverse repo and they're getting money from the central bank for that, right? It's free overnight cash. Think about all the money that went in there. Why are they going for that cheap free overnight cash? Are they not getting returns in the market? I almost think the repo situation is caused by the risk in the market and people saying, I'll take the cheaper free return in this repo market than I will go and put it out in the market. It could be somewhat of a vote of confidence where people think the market's going in the long term.
Oh, no question about it. I mean, the reason why you wouldn't lend that money out, whether it's to other banks that need it or first of all, I don't think there's a big demand for commercial business loans other than to issue debt and buy back shares. You know, these businesses are all cutting way back on CapEx. I mean, look at what Walmart said yesterday. It's canceled billions of dollars worth of orders in the second quarter. So the banks have all this liquidity that the Fed created and they don't have anywhere to go with it. So the Fed's like, hey, we'll give you free money. Just bring it into the reverse repo facility.
Didn't it baffle you that they're not buying 12-month T-bills or 2-year notes? I mean, okay, inflation's high and all that kind of stuff, but I mean, shit, you get your money back. I mean, you get your principal back in 12 months. Why are you going to earn 5 basis points annualized on your overnight repo and then just leave it sitting there? I mean, when the 2-year note was 25 basis points, okay. You know, when they first bumped that rate up, a little over a year ago, when it was June in 21, it's just, I pondered this.
Is that a loaded question?
Well, no, it's not. I mean, it's not rhetorical.
I can answer that.
Well, why, if you're say a money fund or whatever, and that's, you know, they had to start the dynamics of that back in the summer of last year, when the 2-year note was under 25 basis points, the Fed had to start paying 5 basis points on excess reserves to lessen the demand for all that short-term paper so that those rates wouldn't go negative. Well, shit, year on, that's not a problem anymore. And that cash that's sitting in the reverse repo just keeps going up.
All right. I can answer that question for you.
Because you're the old grizzled veteran, I hear.
So the 2-year rate is at 3.29.
Yeah.
So first of all, the banks they don't want to take the duration risk, because what if they need that money and the 2-year rate shoots up to 4%? It's a losing trade for them.
That's what I was going to say.
Buying a future.
The repo market's like a short-term treasury in a way, isn't it?
Yeah.
The repo markets are riskless, 2.5% rate of return or 2.25%, whatever they're paying on the reverse repos right now. I mean, even a 3-month bill. I mean, where's the 3-month bill is at 264. Well, let's say you buy that bill, and for some reason you can't. If you're a money market fund, all of a sudden you start getting big redemptions, and you got to start selling your assets, and the 3-month bill shoots up to, even if it just goes to 275, you're taking a big hit on that capital. I mean, that's how you break the buck on a money market fund.
So, but I thought they were still paying only 5 basis points or something on excess
Well,
reserve.
it might be on an overnight basis, but annualized, they've moved the reverse repo rate up to something like, it's just below the Fed funds rate.
Well, then that's why you leave it there. Because yeah, you're right. That cash is basically quarantined. It's just sitting there.
Right.
And what would be the process by which, Dave, they make it a permanent operation and would they sell, would the Fed take that cash in exchange for some of the notes, the bonds and notes on their own balance sheet and swap it back to the banks and make the banks own it and take the cash back? I mean, to make it go away, you mentioned that earlier about, well, they could just, they could do a permanent POMO, and swap. They'd have to swap that for something. Would they swap?
Well, yeah, you're right. That's a good point. They'd swap the,
Whatever they
swap
have.
out part of their balance sheet
Yeah.
for that liquidity and then destroy that liquidity.
And who on the other end of that is the people that have that liquidity. They're not going to go for that. You know what I mean? It just seems like such a conundrum.
I mean, if the Fed forces the issue, I think you have to.
Yeah. I mean, yeah. Well, yeah. If you're one of the member banks, what are you going to do?
Yeah.
No, it is. I don't know. I guess for me, it all kind of gets back to how upside down and everything inverted everything is since they started all this crap in 2009. It's going to be a one-off. Oh no, the Ben Bernanke said it was a one-off. They weren't monetizing debt, even though they were buying treasuries and that kind of stuff. And all they've done is do more and more every time. Go ahead, Dave. Sorry.
So the annualized rate on the reverse repo as of today is 2.3%.
2.3. Okay.
And it's free money for these banks.
Yeah. Then why would you take it out of there? You're absolutely
the
right.
safest. It's liquid. It's like we talk about where would you put your money? You wouldn't put it in money market fund or a CD because you're locked in.
Yeah.
Or you have risk. So what the banks are doing is saying, let me put it in some bank account where I'm going to get a higher interest rate than anybody else in the economy. Why would I deploy it?
And overnight, and you got liquidity every single day.
That's right.
Yep.
Chris, last thoughts. I know we've been going for quite a while, and I love this discussion. I love you guys being here. What are your last thoughts? It can be anything you want to talk about, but in terms of where we are in the market and what you'd like to say to the viewers about that and your thoughts on that.
Well, I think what we're just talking about leads back to what you said earlier of why aren't people getting it? I mean, a lot of this gets pretty complex. I mean, a lot of it's uncharted territory. And in terms of gold and silver, I guess there are times where I've thought things were closer than they might be, yet perhaps looking at it as insurance against all this, maybe would be how I would update my thoughts rather than thinking, all right, well, silver goes up to 26, 27 bucks or 30 or 35. And then, I mean, that was never really necessarily my plan to sell there, but just that gold and silver being insurance against some of these factors, which get patched up and can get patched up longer than we might expect. And perhaps updating really the framework and what the goal is that you're looking at gold and silver too.
Agreed, understood. So my last comments are, and kind of tagging off of what Craig said, you go back to the Stranger Things world on Netflix, you have the upside down. And I feel like we're living in the upside down world. And my tether to physical reality here has always been gold and silver. So for me, I'm holding on to gold and silver because I want to get back to some rational, sane world, which makes sense. And that's what I'm holding on to. Certainly people can do different things, but while we're living in an upside down world, I do think it helps us to touch base with each other once in a while and just check and see, are we crazy? All this stuff is happening and nothing seems to operate during the normal laws of physics. And sometimes, it just goes back to, human nature and the way people respond to things. And I don't think we're quite at that capitulation point where people want to move and want to admit it and want to say this is what's going on, other than guys like us who are sort of the hardcore analysts. And I suppose maybe that's the way I would look at it. Craig, if people want to reach out to you and get more, I know that you have a report so we can see there in the background. How do they do that?
It's tfmetallsreport.com.
Mm-hmm.
12 years of this and going strong. It's funny. As you were talking, Rob, I was thinking, what do you do? Well, The site's been around for 12 years, but it was 9 years ago this month that I went to a subscription platform rather than just ads, and the like. And I'm glad I did, obviously. But so that means August is still, because there's people that are still have been members ever since then. So I get kind of a surge of subscription income every August. And so I'm going to have some leftover cash at the end of this month that I got to do something with. And so what am I going to do? I'm not sending any more money to Schwab to buy miners, which is probably a good sign. That means they're probably due to go up. Oh, I'm just going to buy more gold. I mean, the easiest thing I can do is go to OneGold, where I keep money, that the digital platform of APMEX. You buy close to spot. JM Bullion's got a platform like that as well.
Yep.
I'm just going to buy more gold. I mean, you just said, Rob, you got to buy something real, hold on to something tangible when everything seems like so intangible and unreal. So rather than, stick it back into some other paper investment, I'm just going to buy myself some more ounces of gold this month and just keep doing it, because in the end, the math is the math. And what's old Brent Johnson always say? If you believe in math, then you own gold. If you believe in magic, go ahead and buy all the other crap. But if you believe in math, you own gold. And I certainly believe in the math.
So Dave, I think you write a couple of newsletters. Tell people how they can get in touch with you on your research.
Sure, but I have a question for Craig first. Have you totally expunged the name Turd Ferguson?
No, I use it. I still use it on my site.
I've been wanting to ask this question.
Yeah, no, I still use it on my site. I sign off my daily podcast with that every day, because.
But it used to be everywhere.
Yeah. Well, that after a while, that just doesn't work,
I love that name.
Well, so on my site, it's like any other website, you pick a username, so everybody's got, you log in, not with your real name or your real email address, but whatever your username is. And my username is still Turd Ferguson. So when I
love it.
When I close out my reports every morning, I sign them TF. And when I wrap up my podcast every day, it's always Turd Ferguson, signing off kind of thing.
I love it. So yeah, my website's Investment Research Dynamics, and you can find more information about my newsletters there.
So Chris, I know everybody in my audience already knows you, but please let people know where they can find you in case we have some new viewers this time.
Well, you can find me at 𝙂𝙊𝙇𝙀𝙍 and also YouTube, where we do the show, 𝙂𝙊𝙇 Economics, and have a lot of conversations like this. And Rob, I was fortunate to just have you on last week, and Dave comes on often, and hopefully we'll have Craig back on there soon, just trying to bring different voices to make sense of what's going on and provide different perspectives, especially with gold and silver.
And
yeah, I look forward to your research, Chris. I know you reach back in history and look at testimony and things like that, and you really provide like a view on that market that a lot of us haven't, and kind of looking at the players and how that's all kind of taking place. I do appreciate that view, and I think it's super unique on your channel. And I want to say, for all you guys, I appreciate you guys coming on short notice. I mean, I really do. A lot of you guys have been people I've relied on in my own research and my own learning of this market over the last 13 years. So I appreciate everything you guys do, and hopefully you guys will continue doing this in the foreseeable future. Because like I said, I read and watch what you guys do, and I appreciate that. And I know that my audience will too. So thanks everybody for jumping on. We appreciate that.
Thank you, Rob.